Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF report. Here we are, September. The worst stock market month is proving its reputation as the market is going down, down, down. And I'm recording this on Friday, September 6th. And remember, you're reading this on September 7th. So, yeah, we're into the worst month of the market. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to invest better than Warren Buffett does now. And we're going to show you one way to do that. Don't forget that if you want a full 3-month subscription to any of these videos that we have, we put out 3 a week, 3 different videos on a Saturday. You get the 3 videos, and on Tuesday, Wednesday, Thursday, and Friday, you get a letter on the market and timing the portfolios. All we need is your name and email. We want you to get a free month subscription so you can see what we're all about. All you have to do is go to buffettandbeyond.com. Buffett is spelled with 2 F's and 2 T's, buffettandbeyond.com, and give us your name, your email, and you'll start getting a full month free subscription to our letters. First of all, let's look at a chart of the NASDAQ 100, which is the QQQs, and we can see from the top indicator up here that we are almost down to the oversold position on this chart, usually where we're looking for a pop-up in here over the next couple of days or so, sometime next week, of course. And down here we can see this indicator on the candlesticks, the big decline that we're having today. And again, I'm recording this on Friday around noontime, and we can see how far down it's coming. This line down here, yeah, 200-day moving average. We've been there before, so let's see what happens. Let's see what the volume is by the end of the day. And finally, when it does hit there in a day or two, we'll see if it stops, if this 200-day moving average can hold. Down here, this indicator is certainly pointing down, and we are now entering oversold territory. So that's a good thing in that, well, we might have further to go in the market to the downside, but at least we're getting there. And don't forget, the numbers came in today that shows the economy is slowing, and that's what the market is worried about. But the Fed is getting ready to lower interest rates, and now they're saying they'll lower interest rates about 1% over the next 4 months, 3 to 4 months by the end of the year. So that's good for the market. Now let's look at the SQQQs. The SQQQs are the exact inverse of the QQQs. So in other words, when the QQQs go down, the SQQQs, which means short, the QQQs go up. And this is what we are using as a hedge. So we bought it in here. In fact, we bought it way back in here. And we're going up. And this is helping to cushion the decline by almost half, call it 40%. We'll see that at the end. So let's look at the Dow Jones. The Dow Jones, yeah, here's the high. Here was the intermediate high. This market broke through that high right in here, held it for about 2 days, and then just washed out. 20-day moving average, it's below that. And watch our Saturday market recap, and we'll do a little bit more on the S&P 500 with this 20-day moving average in here. So we're going down to the 50-day moving average, no doubt about it. And down here we can see this indicator has turned down, and we have more downside to go. Looking at the S&P 500, we are looking, it broke through, it's tried to hold a 50-day moving average in here for a couple of days. That's this blue line right in here. It had broken below the 20-day moving average, and now in these down days, it is pulling the 20-day, the green line, 20-day moving average down. We really don't want to see it cross, because look what happens when it crosses or just before it crosses. Yeah, the market hits a low, or did hit a low last time. So anyway, we're in the same spot down here. What we don't like is this line coming down here. In other words, a lower high where the market didn't reach a higher high, but it reached the high. We have a double top in here right now, without a doubt, and this indicator pointing down. So let's look at the housing sector. What's the housing sector doing? Well, it was doing pretty well for a while there, and then all of a sudden it's breaking with the rest of the market. But today, look at this black line in here, black candlestick. It's actually up a little bit for the day. Why? Because interest rate declines are good for the housing market. So even though the general stock market is falling apart today, the housing indicator is showing signs of buying coming in because people want to get in these stocks before the Fed lowers interest rates in just about 2 weeks. So this is why we're getting a little piece of a pop in here, and that's what we're looking for, because we do have some housing stocks in several of our portfolios, and we're waiting for them I'm waiting for them to turn up. They turned up today, just a tad. But anyway, that's what we're looking at. So this is, you could tell just by looking at these charts what the market is doing and also what the market is thinking. And the market says, yeah, if we're going to drop interest rates, housing should do better. And when we look at the transportation, well, right up to last week, the transportations were looking good. And we looked at this chart and we said, wow, the market is really looking at the transports, because that's usually a leading indicator of the market getting ready to transport, or actually transporting more goods, more raw materials to the manufacturers. Then the manufacturers transport the finished product to the retail stores, and then we drive over and buy at the retail stores or push a button on our phone and the retail stores deliver to us. But the last 2 days just could not hold that upward trend, and they're selling off just like the rest of the market. And one thing I want to bring out, folks, that when the market sells off, just about everything goes with it. And when we look at the healthcare, can we get any? See, I'm looking for a good chart here. This is why we're going over all these charts. Healthcare was doing good until the past 4 days. Then all of a sudden it's down and trying to hold the 20-day moving average. But the intermediate term indicator has turned down. And you can see these red vertical bars in here. These red vertical bars represent the market, or this particular index in this case, on the days that the market closes down. And you can see that the red lines have built up higher than the green lines, and the green lines are when the market, or this indicator, or I should say this ETF, closes up. You could see the volume was light, and then all of a sudden it built up to where the down days have more volume. So we're getting the high volume in there, and that's a good thing, because once you get that high volume in there, this market is getting ready to bottom, but it's going to take a little while. And when we look at the technology, yeah, just in bad shape. Technology and semiconductors, which I'm going to show you in a minute, leading the market down. And this is the 200-day moving average. And right now, the XLK, the technology ETF that we use, is below that red line. And then when we go to the semiconductors, same thing. We're below that 200-day moving average. This indicator has finally turned down, intermediate term indicator, but we're getting into oversold territory. So that's good. In other words, yeah, we're going to see some more downside action. But the thing is that we're getting oversold, so we're going to get a pop in here probably sometime next week. When we look at the utilities, finally, yeah, here's a chart that isn't too bad at all. And still, the past 2 days, it's starting to peak out and maybe turn down in here. We could see a little bit of a short-term sell signal in here, very, very short term, and we'll see what happens. But of course, with interest rates coming down, the market participants who want dividends got into these dividend-paying stocks, which are the utilities, plus they have some growth with them. So you're getting dividends along with growth, and growth of those dividends. So growth of the stock and growth of those dividends. And there was that one time where I ran a portfolio strictly of utility stocks and used to write covered calls on that. And it was a very, very nice strategy. And we had a market crash, and the utilities finally broke down and went down at that particular point. They dropped with the rest of the market, and that was 1987, Black Monday, October 19th. And the utility stocks fell drastically when the market finally broke. The Dow at that point, on that day, was down 22% in 1 day. So it was a market malfunction, and a long story, but the futures in Chicago which were used for protection, did not hedge up with the stocks in New York, and therefore the market just kind of disintegrated for a while. But boy, we bought these utility stocks, and that kept us going for the next 10 years or so, because the dividends almost doubled because the stocks fell so much. So in other words, when people panic and they start selling stocks, they'll sell everything. And they sold the utilities, but really, who was going to go without lights? And yeah, we were able to go in and bought, and the people I was working for actually bought these, said, what do we do about the utilities? I said, buy them. We're not going to get another chance like this, and never have since then. So we're seeing this little break in the utilities, and we'll see what happens. So let's look at the gold shares, because gold has been hitting all new time highs, and this is the Spider Gold Shares, GLD, so it's an ETF, and the shares are doing pretty good. You can see the general climb in here, but this indicator down here has pointed down, so some of the stocks in the gold industry are starting to fall down. Gold is still going up, but the gold stocks now are starting to, well, I wouldn't call it exactly break down, because they're pretty even in here. Gold is actually keeping these up, and they might be good after some of this dust clears. Now let us look at the QQQ top 11 stocks that we have here. There's actually 12, but we're out of Tesla, but we're in here with Tesla. We had a 2% loss on this stock for the year. That will remain with us, but we don't have the Tesla stock. Now this portfolio has come down. The QQQs have come down about 7-8%. The S&Ps are down about 4 or 5%. This is just in 1 week. And our top stocks are down about 10% from a week ago, about 10% percentage points. So with the hedges, because we have about 10% of the portfolio, 11%, 12% of the portfolio we have in hedges, in this case 10%, that adds 5.8% to our returns. So when you add 5.8% to that, we get about 26.2% if we're using hedges, and most of you are. Most of you have these hedges in there. Now, when you look at this 26%, you say, well, from last week, the portfolio with the hedges, we're still down about 6%, which is less than the 10% that the stocks fell. But if you hedge them a little bit, you're down about 6% rather than the 10%. So it's nice to have those hedges in there, and we've added about 5.8% to the portfolio this year through these hedges. And I'm going to show you something neat in the next slide. But the point I want to bring out here, up 26% so far with this market falling apart. The S&Ps are up 13.7%. So we're still doubling the S&P 500, and we still have some hedges in place. And the QQQs, 9.9%. We're almost, well, from picking the best stocks in the QQQs, we're almost tripling the QQQs themselves by picking the best stocks in the QQQs and adding about 5.8% of hedging. Now here's something I want to show you. We've been keeping track of these hedges since the very end of 2023, almost the last trading day. We got into the SQQQs, and you can see that was not a good move because we lost about 10%. This is strictly the QQQs and the SQQQs. So when the cycles turn down, we get into the SQQQs, which are the QQQs short, so the NASDAQ 100 short. And then when the markets turn around, we get into the QQQs, and the QQQs are long. And that's what we did with the hedges. We just used the QQQs and the SQQQs. And folks, we are up 40%. Now we started at 100%, so you have to subtract 100 from the 140 here. But just the hedging alone, in other words, if we had a portfolio, we just used the QQQs and the SQQs, we'd be up 40.6%. as of midday on Friday. Kind of makes you want to think that, gee, maybe we should have a portfolio where we just have the QQQs and the SQQs. Meanwhile, we don't. So anyway, and this yellow is the position that's still open, and we got in at 8.4. The portfolios that are managed by other money managers got in at a better price, and they're making more, but this is our official price, so we have to go. When I wrote that out to you on, I think it was a Wednesday afternoon, on the 28th, that afternoon, it was that 8.4, and that was the closing price that day, so we have to use that. So we're gaining 13.7%. That's not our biggest move so far this year. We had a 31.9% in here, again going short. So here we are short again. But all in all, we're up about 40.6%. Now, we don't put all our money into the hedging part. We put about 10% of the portfolio in it. And let's see that again. And that gives us about a 5.8% return, doing very, very nice in this position. So we're still up with the stocks. And these are good stocks, and when they turn around, these are going to shoot up. You could be sure of that, because they're more volatile than the S&P 500, and they're the stocks that are making all the money too. Up 26.2%, up just about double the S&P 500, almost triple the QQQs, the Nasdaq 100 itself. 26.2% is not a bad return. 22.6%, if you don't have any hedges, is a very nice return. So, folks, we're doing pretty good. And we're coming into the last 4 months of the year. So we'll see what happens. And this is usually the worst month. And then the market turns around sometime in September, or it could hold on if it's very bad going into October, and then we have the end of the year rally. So we expect a good overall return as we come into the end of the year. Now, what's going to happen depending on which administration wins the presidential election? Will taxes be lowered? Will taxes be raised? If taxes are lowered, these stocks should do better. If taxes are raised, that means more money goes to the government, less money goes into paying the workers and putting money into research. And that's just how it works, folks. We're not talking about one party or the other, but if taxes are raised, the market slows down. How much does it slow down? Hopefully not too much, because as Warren Buffett says, while he was alive, he was under, I think, 12 presidents. 6 were Democrats, 6 were Republicans, and he's made money under no matter who's in office. So that's what we have to look forward to. No matter what, we're in the good stocks. So whoever gets elected, fine. Our companies are still going to grow. It's just a matter of at what speed. And again, our hedges only are doing beautiful. If we had a portfolio of just these hedges and timing those hedges and playing those cycles, we'd be up 40.6%. Not bad at all, is it, folks? So, listen, if you want to walk on the beach like Jimmy Buffett once did, and he lived about 6 miles up this beach, if you want to be here like he used to be before he passed away, then you've got to learn how to invest even better than Warren Buffett does now. So, folks, it's been a tough week. Go out, clear your heads, be with your family, have Sunday dinner with them, and we'll be back in a few days. Stay safe, everyone.